Good morning, everyone. Welcome to today's morning coffee with Mike. We've got a choppy market. And the question that I'm hearing a lot is should you sell or should you hold? Well, what should you do? In choppy markets like what we're experiencing now, especially the type of choppy markets where you've been running for a little bit, things are starting to look good, and then all of a sudden the market pulls right back in, can leave us with a lot of questions, and it often leaves us with more questions than answers. The solution that I used to have for this that would frankly drive me nuts, let me know if you fall into this camp, was to come up with rules and to come up with a whole bunch of buy rules, a whole bunch of sell rules, a whole bunch of hold rules. And when I would take a look at the market and the trades that I would have, it would drive me nuts because I would be going through all these different rules for buying, for selling, for holding. And what would happen would be I would have conflicting rules. And then what happens when you have conflict in trading? What happens when you have conflict in trading? What happens is that you have indecision and you kind of look at the screen like a deer in the headlights, wondering, well, should I do this? Should I do that? Some of these rules say that I should buy. Some of these rules say that I should hold. Some of these rules say that I should dump my whole position. What in the heck should I do? So I would be in this scenario, and eventually, what would happen would be I would make an emotional decision based on however I felt, and that would be it. That's not the way to long term profitability. And I've learned that lesson the hard way many times over. So, the solution that I came up with that I wanted to share with you today on this show and walk you through a little bit is a concept called danger signals. What's a danger signal? A danger signal is something that's telling us that the market is starting to move against us, right? Pretty straightforward, pretty simple. So, what's the idea with these danger signals? The idea is that with a signal, you're not taking immediate action. It's more about weighing the evidence that the market is giving us. So, for example, if we get one danger signal on a trade, that's probably not going to be enough to prompt any kind of an action at all. If we start to get three, four, five, maybe that's something to start to put the antennas up. If we start to see six, seven, eight, then that's something that will require more immediate action. And the way to or the purpose of this, or well, what it's going to help us do is it when you see the market pulling in sharply, just like it did yesterday, and you start to have questions like this, what it's going to help you do is to not freak out. Because if you have a mechanism that weighs danger signals, that weighs the evidence of what's happening in the trade, and you see what's happening, and you're like, oh, well, it actually has one or two danger signals, but that's it, then that's something that could take a load off your mind and help you be a lot more calm while the bullets of the market are flying. And that's what you want. You want calm, you want clarity. And the more clarity that you're able to have, the better off you're going to be. Let me share with you a few of the signals and things that I look at that I consider here. So why don't I bring this Instagram over here and we'll look at a trade that I'm in right now. Get this calendar out of the way. See if we could zoom in a little bit. Oh, yeah, you can zoom in a little bit right there with Instagram. All right. So, what we've got here, let's make this a little bit cleaner here. So, what we've got here is a trade that I'm in called Duolingo. And I'll put my annotations on the chart briefly here so you can see all the different things that I was looking at yesterday, right? So I've got all those danger signals, right? The yesterday this trade had six danger signals altogether. When you're just looking at this bar right here, let's get rid of all this noise. Right, I like to draw all over my charts, and they mean a lot to me, but to you guys, it's probably confusing. So on this day right here, right, negative outside reversal day. I guess it's negative if you're bullish on the trade, but if you're bearish, you probably like to see that. But it's just an outside reversal day that closed on its lows, and that's something that I would consider a danger signal. And if I'm in a trade, when I used to be in trades before I had this concept, I would see a day like that and think, "Oh my God, price pushed higher." And it closed on its lows and it's starting to close below one of these moving averages here. That's scary. What should I do? And I would get freaked out. A move like that would freak me out, and I would end up dumping the trade. So a better solution to a scenario like that, like we just saw, was to come up with this concept of danger signals and how to respond in different points of the trade. So I want to walk a little bit deeper into the weeds with you here, and then we'll talk about the larger philosophy of this that you can take away with. And if you have questions, you could always reach out to me, drop comments wherever you happen to be watching this, or reach out to me on marrowwealth.com for more advice. So back over here, and share this screen. So over here, I'm looking for at least 7 danger signals in order to aggressively raise my stop up, right? So it would have been to yesterday's low to aggressively raise a stop, or to just let the trade continue to work here. With 6 danger signals, right? Well, you see that there were 6 danger signals yesterday. I opted to allow the trade to continue to work. Now, why would I do that? The reason is because this trade already met my first objective, right? So I like to break trades down into really 3 objectives. Actually, it's 4, but the like 3 primary objectives. The first objective of any trade that I'm looking to take is to first get risk off the table. And this trade did that. When price broke out and I initially had my stop over here, my first objective is to get risk off the table, right? So get my stop loss to break even. I did that already, and I already hit my first profit target in this trade. So I like to scale out of trades. I like to take profits as a trade works in my favor. I like to sell into strength. So it did that, and I took my risk off the table. So there's none of my initial capital risk on this trade. So I'm able to let the rest of the trade sit and work and hopefully make more money. So when I get to that part of the trade, I consider that to be the mid game of the trade. That's when I want to allow the trade a little bit more wiggle room, because frankly it's earned it, right? It's already made profit. The trade has already made profit. It's already moved in my favor. I already taken the bulk of my risk off the trade, so I can sit there. It's earned the luxury of sitting there and letting it work. So that's what I'm doing here. I'm sitting here and allowing this trade to work and allow it to do those things. And by measuring the danger signals, I'm able to have the confidence in order to do that. Now, here's some of the philosophy part of it for you, right? Here's the philosophy on how you're going to make this work. So you might hear something like this and think that, oh wow, that's great. Mike has all these danger signals. Uh, I want danger signals too. Let me just copy his. Well, the way that it was finally able to work for me, where I'm able to just look at this, see the danger signals, and then be like, okay, I'm going to allow this thing to work and not lose sleep over it, versus having concepts trying to make them work and then kind of sitting here hoping like, oh, gee, I really hope this works. Am I going to make money? Am I not? And then you know the feeling. The way that I got past that point was by going back through my prior trades in post analysis time and testing out these danger signals and seeing the different types of results that I would get. Would trades perform better? Would trades perform worse? What was the proper time to exit a trade when it started to break down? Like when would it be the end of the move versus just a normal pullback within a move? Because I went back in time and tested all this stuff on my prior trades and did that level of post analysis, that's what gave me the confidence to be able to execute in this way. So the concept of danger signals can work for anybody to help you begin to manage your trades. The way that you're going to obtain the belief to be able to execute this. And beliefs are different than ideas. Ideas are what you're getting right here. You're getting a whole bunch of ideas. Maybe they sound good to you. Maybe they sound like crap. We've got a bunch of people that are still watching here. So at least a few of you still think that it sounds good. But you get the idea of the danger signal. The way that you're going to get the belief is to actually go and begin testing it for yourself, applying it, doing that kind of work, seeing how it works. So that way you have the hard evidence that yes, this actually does work. I understand how this works, and you're going to be able to go off and do it. So that's how danger signals work, and that's really a great way to alleviate a lot of the stress of trading. Of, well, what should I do? Right? It answers the question of what should you do. The answer of what you should do is going to be to follow your rules, and you have your danger signals there, and that's going to help you decide what should you do in any given scenario. I talk about it a bit in the Trading Mind Wheel book here. Book has been available for about a month, I think. Well, when did it come out? Beginning of April. Well, what are we? That the end of May? Yeah, so it's been out for about 2 months now. Go check it out. It's on Amazon, Barnes and Noble, Walmart, everywhere books are sold, and the audiobook is now available too. You can get Audible audiobooks, all that audio stuff. It's available everywhere. So go listen to it, go read it, and reach out. All right, time for questions. Time for the Q&A. Let's go through it. I see a bunch of stuff coming over here on the gram, the Instagram. Let's scroll down through the top here. All right. Can only technical analysis be okay to enter into a trade? Yes. Short answer is yes. The longer answer is that it depends on your system. So, what system have you developed for yourself? So, is it okay to enter based only on technical analysis if for the person that cares about fundamentals, right? For them, the answer is probably going to be no. If you're starting from scratch and you're looking to try to figure out, well, what types of systems do I want to have? You could build systems off of anything. And you can build systems based solely around technical analysis. That's totally fine. Your objective is to, well, yeah, part of everybody's objective is to make money over the long term. But there's other objectives that you're going to need to bake into that as well. The time investment involved in it, how the types of returns that you're going to hope to make with this thing, how active you want to be. There's a bunch of different factors, and whatever system you're going to come up with has to align with your beliefs, your goals, and your ability to execute. Because if they don't, it's going to fall apart. You can't act on what you don't believe in. That's why I was talking about that danger signals concept earlier as an idea versus as a belief. You've got the idea of it now, but in order for it to be a real belief, you've got to put in the work. Right? So beliefs, your goals has to align with all your different goals. Like, so if you have a certain goal where you're trying to make money for income versus growing money over time, certain systems will be able to do one better than the other. Finally, your ability to execute. If you're not able to execute the system, let's say that you're working full time and you can't be in front of the screens when the system needs to be executed, well, it's not going to be very good to you, is it? So that's why it has to align with your beliefs, goals, and ability to execute. All right, next question. Question or comment? Yeah, I think a little bit of column A, a little bit of column B from El Cigar over here on Instagram. Isn't it better to wait for market structure to form direction and enter upon confirmed setup for the sake of proper risk management? Again, that's going to depend on your system. So I'm going to speak from my own perspective. I'm going to look for proper setups. And the way that you define a proper setup is extremely important. You're going to want to figure out the definition. So, what's the characteristics of the setup that you're looking at? Well, what's the shape? What's the structure? How how many bars does it take to make this thing? What time frames are you looking for this thing on? Are you looking on weekly charts, daily charts, intraday charts, monthly charts? How long does it take this thing to form? What trend does it need to be in? Uh, what's the proper depth of the pattern? What's the proper depth around the pivot area for this pattern, right? So you're going to come up with the baseline criteria of whatever the setup is going to be. And then after that, you want to figure out, well, what takes the baseline criteria from good to outstanding, right? Like, well, what's the best model book setup for this type of thing? And so my solution to that is to have a laundry list of boosters for that type of setup. So if it has X, Y, and Z, then great. That's going to make this one higher probability for success when it's under these set of conditions. Then your next step is to have models of those types of setups. So go back in time, find the ones that perform the best, and take snapshots of those. So that way, when you're looking at a current setup, you can see how closely does it match the model. Well, it's pretty close. Well, do you want to trade pretty close, or do you want to trade like 95% of the way there? Does it have to match exactly? What exactly is it that you want? And then go with that. I would say that it should match pretty damn close. All right, next. Next question. Watching from South Africa. Welcome, welcome. Hey, Mike, do you consider a minimum dollar volume on a stock before even looking at it as a trade idea? Great question. The thing that I'm looking for uh, isn't so much dollar volume, but more so trading volume on the day. I do have a minimum criteria. I'm not trading stocks that are under $5 a share. Most of the stocks that I'm trading are over $100 a share. Like your Duolingo that we spoke about earlier. Duolingo is trading at about 150. So looking at dollar volume becomes less of an issue. However, if you are trading lower price stocks, then I can see where dollar volume comes far more into play. Uh, One of our coaches, Stu Chalmers, he uses dollar volume and it works out fantastic for him. He trades some lower price stocks than I do. And part of the reason why is because he finds high type flags in those stocks that can go and double very quickly over time. for him that fits his style a bit better. He's able to handle the bigger volatility very well. I like stocks that trade a bit tighter. So that's why I'm looking more so on stocks that are trading 50, $100, more than that. And yeah, it's a matter of finding the types of stocks that fit your criteria. One of the things that I talk about in the book, in our programs, is building a universe list for yourself. What's a universe list? A universe list is going to be all the different stocks or whatever it is that you trade. You're going to narrow down that field, right? So that way you're only looking at the types of stocks or the types of whatever that fit your baseline parameters. So for me, I'm looking at certain fundamental criteria, things like extraordinary earnings and sales. I'm looking for growth and leadership, all these kinds of things that fit into the or that's going to give me the highest probability of success for the types of stocks that I'm looking to trade. And that's why you would want to start off with your baseline criteria too. Well, what's going to fit the types of stocks that you trade? Went off on a bit of a tangent there, but hopefully that was helpful. Let's see, what other questions do you guys have? Got time for maybe one or two more questions. Which is the best indicator for trending? There is no one best indicator. Took me a long time to uh, realize that one. There's no one best indicator, but I will tell you the indicators that I use and where they came from. A lot of people look at moving averages as an indicator. If you do, that's one of the things that I use. And well, why do I use that? Well, it came from what I had learned in the past. When I studied the first thing that I studied that stuck and worked was William O'Neill's Can Slim methodology. He wrote a book called How to Make Money in Stocks. That book is fantastic. If you're interested in trading growth stocks, I highly, highly recommend it. One of the things that he talks about in that book is the 50-day moving average, the 50-day moving average and the 10-week moving average. And the reason why is because he found that most of the stocks that he traded would hold above this line when they would break out and start their runs. And he would use that line as a guardrail to stay in the trade. So if it's trading above the 50-day moving average, great. Then you can continue to let this trade continue to move. And another thing that he found was that the major institutions of the world, so your hedge funds, your pension funds, your big mutual funds, would step in and support the position at that level. Still true today. So in reading that book, I started to see what he saw and I tested it out for myself. And lo and behold, I found it to be true. So that's why I started to use that moving average. And then I read some other things about other moving averages and I started to incorporate some of those. That's why when I shared my charts before, you saw a few different moving averages on there. So I like moving averages. I find them helpful to stick with a trend. And we could go deeper into moving averages at another time. Hopefully that gives you a good baseline. Thanks for clearing that up, Mike. You're welcome. All right. Looks like that is it for today. Hopefully, you found this one helpful. Let me know down in the comments what you thought about today's episode. Reach out if you have questions, and I will see you back here tomorrow at 9:30 a.m. Eastern for the next episode of Morning Coffee with Mike. Take care. Much love. Peace out, everybody.